Bridget, good to see you. We are diving into the headlines today. High earners age 50 plus are about to lose a major tax break. Starting in 2026, workers age 50 and older who earn more than $145,000 will lose a key tax break for their retirement savings. What's new?
Well, they're always changing things, aren't they?
Yes.
The latest one is right now, if you want to make catch-up contributions to your 401k account, it's tax deductible, just like your regular 401k contributions. But starting 2026, if you earn over $145,000, that catch-up contribution is no longer going to be tax deductible. It's going to be taxed and then put into a 401k Roth account.
So this is a big change. How will the switch to after-tax Roth contributions affect take-home pay and future withdrawals?
Well, obviously, if you're not getting the deduction, you're going to have a higher income base for your taxes. But on the plus side, that money is going into a Roth account right off the bat, so we don't have to worry about doing any conversions. Ultimately, we want to get as much money as we can in the Roth section of the plan, because once it's there, it's tax-free forever, and we don't have to worry about future tax rates.
Right. This all might be good news, which is what we're hinting at.
Yeah.
Which, kind of brings us to the million-dollar question, Bridget. How should somebody determine if they should be contributing to a tax-deferred or a tax-free account anyway?
There's a lot of things to consider on that. Everybody's situation is unique, which is why we take the time to really go dig into it and look at your personal situation before we make these decisions. It's not a one-size-fits-all approach. We've got to take into consideration what your current tax bracket is, what the current tax rates are, and what the potential future tax rates and brackets might be. So all those play in. We also have to take into consideration your legacy planning and how you plan to leave that for your children and heirs in the future. We are at historically low tax rates right now, and thankfully we were kind of at the end of that. We thought that was all going to go back to the 2017 rates starting in 2026, but they've been extended, so we have a little bit more leeway to get those Roth conversions done and get your money situated in a tax-free situation.
For those people, though, who are kind of married to that tax deduction, are there any other strategies you would recommend, like health savings accounts, to make up for that lost deduction?
Yeah, we love health savings accounts because, again, they've got all the good features to them. They're tax deductible. They are, when you take the money out to use it for benefits, they're tax free, so you never have to worry about tax. You get the biggest bang for your buck out of that. Right now, the rates are $4,300 for a single and $8,550 max contribution for a family plan, with an additional $1,000 available for a catch-up. But you got to keep in mind, these are not available if you're already on Medicare. You can't do that anymore. And there are penalties for excess contributions. So again, it's something you really have to plan for, not just throw in at the end of the year and hope it works.
Right. No, talking it through with you, Bridget, it's clear that this is just one piece of the whole puzzle that is your financial plan. And as you're saying, it's about paying less in taxes over the course of your lifetime, not just this calendar year. So if somebody would like to sit down with you and talk more about that strategic tax planning, what's the best way to reach you?
Well, you can check out our website at www.rileyhiggins.net, or you can reach us at the office, 480-581-8545.
Great. Bridget, thank you for your time today.
Thank you. Have a good day.